Hey guys, so we're back with the third SAC now. So without any further ado, I'm not going to waste any time because this one was quite a challenging one. I remember when I did this one for the first time. And I think it was challenging especially because of this question. Most of the weighting has gone to this question. And in my time when I did this SAC, I started with the other questions. And I actually didn't have enough time to finish this whole thing. Because I actually came on to the main question 1 afterwards after I finished question 2, 3, and 4. Which to some extent was good because I got the question 2, 3, 4 right, but there was not much marks there. So you want to probably start off with the more harder question, especially because this is the testing question, in this SAC at least, to split the top students off. Alright, so it's all about how we annotate this one, so let's get started. Uniform Central is a popular... So Uniform Central is a business, popular school uniform franchise catering for the high school students of Melbourne. The manager has asked you, the accountant, to value the students of Melbourne. Their manager has asked you, the accountant, to value the main inventory lines on hand after their physical inventory count in preparation for their winter sale in May 2021. As Uniform Central's cash flow has been strained. Okay, this could be helpful later. Strained over the last year due to the COVID-19 pandemic. Could be useful later. Wait, why am I on blue? I usually write on red, sorry. There is a lot of writing on the successes of the sale. Please consider the following data. As at 15th April, the monthly inventory count has been completed. So the inventory count has already been completed. Okay, and so this is the stuff they've given. Alright, let's go to additional information. Uniform Central uses the same courier BHL deliveries for deliveries of inventory from the supplier to the business warehouse inventory. So here we're actually trying to, most important thing here is we need to figure out, okay, so the period, which one's the period cost, which one's product cost, and all of that. Before I get into that, let's first write the definitions for these. Okay, so period cost, right here, I'm just going to write it here. Cost incurred, oops. So you guys should know this memorized, to bring inventory into a location and condition ready for sale, which can be allocated. Wait, whoops, I said that wrong, sorry. Which cannot be allocated onto individual units of inventory on a logical basis. And the same thing applies for product pretty much, but product is when it can be allocated. So product cost, same thing, but can be allocated onto individual units of inventory on a logical basis. Right, so it's important to have these definitions clear. Okay, and now we should be able to start doing these questions. So delivery in, right? So it's a cost incurred by the business Uniform Central to bring the inventory into location and condition. So it's bringing it into the correct location, ready for sale. And can it be allocated on a logical basis is the question. And from what they've given us in the question, it can be logically. So we can write this here. Can be logically allocated. So that means, this is really important, this is a product cost. Right? So that means this will be within, so actually not within, added to cost price, let's just say that. Added to supplier's price to make cost price of inventory. right? Okay, so that is quite important, I would say. To understand that is huge. So I might take a bit longer with this side because this one was breaking down this question is probably the hardest part. The rest of it we can probably speed through. Delivery in, delivery out. Okay. Deliveries from the business warehouse to customers. So it's not a cost incurred to bring inventory in location and conditions. It's actually going out of the business, right? So delivery out is actually going to be part of NRV, which we'll get to later. For now, let's just write NRV here, right? And we'll talk to the definition of that later. As per long-standing agreement, the cost of delivery out per item is the same as the cost of delivery in per item, right? So it's the same thing. Delivery in and delivery out are the same. And the reason this is part of NRV is because they are both covered at the expense of Uniform Central, right? So that's why it's going to be part of NRV. School logos are embroidered onto each item of inventory. Okay, so school logo, same thing. It's going to be a product cost again. And it's going to be a product cost because again, and so it'll be added to supplier's price. As it is a cost incurred to bring in the inventory into a condition that is ready for sale, not location just for delivery. And this one will be condition that's ready for sale, and can be allocated to individual units on a geological basis because it's. Oops, sorry. I don't know what happened there. So it can be individual, so can be logically allocated. Individual units of inventory. Labor cost of logo embroidery onto each item is $1. So the labor cost per item, which is again going to be a product cost. So all of these just mean that the cost price of the inventory is just these little costs are going to add up to make the cost price. Because the cost price is going to be just purchase price, which they bought from supplier, plus all these little product costs. $100 worth of thread was purchased from the department store for the month of April. Okay, so this is actually made period cost because it cannot be logically allocated. So this, my friends, will be a period cost. Okay, so that is good. Alright, so looks good so far. Let us keep going. Shirts and trousers are marked up by 50%. This is huge, right? So it's shirts and trousers are marked up by 50%, right? But then shorts, skirts, dresses, and socks are actually going to be marked up by 100%, which means there's a different markup for each of these guys, which makes our life kind of annoying, but that's what we have to deal with here. All of these excluding GST. The summer uniform. Okay, so this is the inventory write-down part, which they'll say, oh, they've reduced it for some blah 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 reason. This is quite common. They'll do this for all things. So this is where you calculate the inventory write-down part, right? So here they're saying they've dropped the price of shorts and dresses, right? The trick here is actually the wording they've used. So it's reduced, declared, usually the conclusion. There's a conclusion of summer and stocking up for the new winter uniform items. Yeah, that makes sense. Dresses are marked down. So the dresses are marked down by $30 each, right? So whatever the price is, they've dropped it by 30. But the shorts, on the other hand, are marked down to 30. So it's not, again, but it's not being reduced by 30 to what its original was. Whatever the price, let's say it was 50, it's actually going to be marked down to 30. So it's just reduced by 20, and the final price is going to be 30. It's just the wording that's kind of annoying here, which we just need to get our head around. And once we do that, that should be fine. Right, so just the wording is something we need to be wary about, because even though this is accounting, this tests a bit of your English skills. It's not heavy English, it's just you need to read through it carefully, otherwise you can miss it. And that's what accounting is. It's really testing your ability to not fall for silly jokes like this. A flat fee of $2,000 is incurred for customs duty on shipments. Yeah, and this is another period cost because it cannot be logically allocated. It's a cost incurred to bring the engine to a location that's ready for sale. So let's actually do this. Now we've actually allocated everything to period, product, and NRE respectively, which is really good because I think that's the hardest part of this question. Okay, fill in the selling price per unit excluding GST column on the table in the case study on the previous page. Okay. So we're just trying to find the selling price, right? And they've clearly said here, the shirts and trousers are marked up by 50% on the supplier's cost price. And same for the short skirts and dresses. Okay, yep, alright. So what we can quickly do here is for shirts and, what was it? Shirts and trousers, it was 50%. So if you're marking up 20 by 50%, you essentially just multiply by 1.5. So that should give $30. So you're just going 20 times 1.5, right? Here we're gonna go $60 because again 40 times 1.5. Sorry about that. Marking up by 50%. All of these guys are marking up by 100%. So when you're marking something by 100%, you essentially just multiply by 2. And I've explained this in the first video in like more depth if you don't understand the markup thing. Here, because this is the third video, you guys should understand the whole markup thing pretty quickly. So we should be able to speed through this. So this will be 50, because that's just 25 times 2. Skirts are just going to be $70, because that's 35 times 2, because all of these are marked by 100%. That's, oh, my pen is lagging again. 90, which is 45 times 2. And this is 10. And again, my pen's lagging. Wow. Shouldn't be this bad, sorry. Right, there we go. So that's the first part done. So it's just 50% markup on the first two. So make a quick note. These two 50% markup. These two have, these four, sorry, 100% markup. So I've just made that make it clear. And that's why it does the calculations. Alright, so now let's move on to this. Explain the reference to qualitative characteristic, why inventory should be valued at the lower of cost and NRV. So this is actually quite a common question. Like I remember when I was studying, I would have done it like when I was studying for this SAC, because I actually did not, this is probably my least favorite content in accounting, which is surprising because it's not that bad of a topic. So that means accounting content is not too bad. But yeah, this is probably the one that I didn't enjoy the most because of the theory part of this. But once you kind of repeat yourself doing a practice, actually see the theory questions are quite similar. So you can almost know how to write these answers pretty quickly. So you should probably make like a theory bank. I've probably said this earlier, where you know how to answer these questions quickly because you want to save time for the exam and the practical stuff. So for this one, so the rule of the lower of cost and net realizable value rule, right, says that when cost is lower than NRV, cost provides a faithful representation of the economic benefit provided by the inventory I'm just going to dot point this. You guys can put in the sentences. I'm just trying to get straight to the point. You guys probably need a bit more flow. But I'm just going to write the key points here. But when NRV so that's what this rule is saying, right? When you record at whatever is lower, record at whatever is lower. Lower between cost and NRV. That's essentially what the rule is saying. But when NRV is lower, the valuation of the inventory needs to be adjusted by writing the inventory down. And this is why we do the whole inventory write down thing, right? And we do this whole write down because this is probably important. Probably might just write this in because it's like a linking point. I'm just writing it with a different color, it just links into this is because the cost price no longer represents the economic benefit that the inventory will provide the business in the future in the form of revenue generation. So it's because it's no longer providing, and this is where we mark it down because it no longer represents the economic benefit to provide the business in the future in the form of revenue generation. And this is where it's being written down to more faithfully represent the reports of the business. And kind of here, you can just make that link. Use a couple of keywords from the definition of faithful rep, and then you should be able to link that in, right? So business should kind of something like, oops. So business should reflect this change by writing down inventory so reports are reflective of real world economic events. Reflective of real world economic events. I'm not going to finish that, you've probably heard it. Real world economic events, that's part of the definition. And then another key thing I would like you guys to say, answer somewhere is probably so that they don't overstate assets and profit. Right, and this you can actually use to even link to relevance, right? Because if they are overstating this stuff in their reports, and when the business owners will not be able to make informed decisions as the reports are kind of biased, right? So because they're biased, they're not able to make the best informed decisions. So it'll breach relevance if they don't make this enrich write-down. So we do make this write-down, therefore we'll support relevance. So you kind of can make these for these two guys. I think the fatal rep one is more straightforward and clear, but I think there's nothing wrong with relevance as well. So yeah, this is probably for theory only. Yeah, when you practice this quite a bit, you should get this. You don't need to write all of this, obviously, but yeah, it's probably, this is like kind of the general idea of it. You can like phrase it and put into sentences. Calculate the total value of inventory on hand as a result of the above information. Okay, this question will take time. And because I'm nice, I'm going to make something that'll make it quite clear for you guys. Which will be a nice little key. Right? What I'm gonna do here is just give me a second, guys. I'll explain everything what I'm gonna do to answer this question. We can go with this guy. School logo embroidery. And put it up. Why not? Okay, so these are all the different things that's going to combine and make the cost, right? Okay, so for these sort of questions, you want to make a nice table, right? Because a big table will help you identify everything. Do this question quite easily. So quantity in, like after inventory count, right? You don't want to take the first one. Right, so here you want to take this value, not the one in the inventory card, because it's the one we want after that, right? Then we want cost, then we want NRV, and then we kind of want lower of cost and NRV. Right, so something like this should do. I'm kind of going quickly, but I hope you guys get the gist of that, right? So first, we're going to do a shirt. Okay, so shirt, from the thing above, we know quantity is 122. Then we do know that the supplier's price is 20, right? And the delivery in, because it's product cost, we're going to add it into the cost price. Is be plus 2, so we add that in as well. And then the logo, I don't think there's a logo. Actually, logo is just for the skirt, shirt, shorts, trousers, and dresses. It's not for the shirt, right? So that means this is 122. And now I'm going to try, this is why I did the little key up there, so you guys understand where I'm getting each value from. So the supplier's price was 20 for this one, and then the delivery in value was 2. Actually, why have I said this stuff? Was 2. So that should be good. And I'll probably just write it with black to make it clear what the final list is. That's 22, right? Then the NRV for this one, actually, what we could do is, I'm thinking, we can do one of the NRVs, and I'll explain why we don't need to work out any more of the ones. Right, so for the NRVs, let's probably just start, before we do the NRV part, let's go on with a little definition, because it can't hurt anyone, of what NRV is, because I just want to clear it up with you guys, in case you don't know. If you do, great, just use this as like a phone to check your understanding. So NRV, estimated selling price. of inventory less any costs involved in its selling, distribution, or marketing. Yep. So you guys should know this. It shouldn't be too bad. So the NRV for this one, the selling price, we calculate it up. We mark it up by 50%. This becomes 30, right? But then there's a marketing cost here. No, not marketing, sorry. The delivery out, right? Because it's a cost incurred by the business to make the sale. So it's like a form of distribution, yeah. So it's like a distribution cost. And it's taken by Uniform Central, so it's gonna be subtracted here. So the actual thing when they make the sale, it's actually worth like $28 because of the distribution cost. Right, and we said delivery out is the same as delivery in, so that's 28. Right, and now the point is we need to figure out whether whatever is lower between these two. So 22 is clearly lower than 28, right? And that makes sense because we've not written down this inventory, right? So because we haven't written down this inventory, we don't even need to usually. So I just did this for common sense because you want to make a profit anyway. For every business, you want to make a profit, right? So for some reason, if after all your distribution blah blah costs subtract from your supplier's price, from your selling price, you want to have it higher than your cost price because that's when you essentially make a realistic profit. So unless you're writing it down, you don't even need to worry about NRV part because cost will always be low, right? So we only need to worry about for shorts and dresses because we know that those are the ones that have been written down. So in those, likely this question will have the NRV being lower than cost. Here I'm just kind of using my brain to cut out some of our calculations. Yeah, so we know cost is 22 then because we're valuing at whatever's lower between cost and NRV, and that's the rule, lower of cost and NRV rule. So here we just do 22 times 122, which is dollar. What did I just do? What is that one doing there? 2684. Okay, now the second one which we need to do is trousers. Right, so if we go up now, trousers is quantity and inventory count 74. Right, this was the other one, 122 for the shirt, 74 for the trousers. Supplies cost price is 40, then there's 3 for the delivery in. So we add that in, but then also now that there's also the logo cost, school logos, which are being embroidered, and then the labor cost as well, which is $1 per item. So for this one, the logo cost for trousers is $3, right? Okay, so this is kind of annoying to continuously write, but just to make it clear for you guys, I will do it. So that's 74, we saw that. That was 40, so then we will add that to the delivery in part, and then the school logo embroidery for this one will be 3 for the trousers, and then finally +1 for the labor cost embroidery, and that, my friend, should come to a grand total of $47. And we already, and this is the part I said earlier, we don't need to worry about calculating NRV because here this part's not been written down. I showed it there that why NRV is going to be high always for these parts because it's not been written down yet. So here I'm just going to assume that cost is going to be higher. You can calculate it, but I already know it's not gonna because it doesn't make sense for the business to make the sale then. If the NRV is already going to be low, the cost, what profit do they even make? You can calculate it and make sure, but I'm just going to be smart. 47 times 74, because I want to calculate whatever's lower. If you already know cost is going to be lower, why bother with anything else? $74 times 47 is 3478. So that's good. That's fine. I'm just going to make this clear for you. Okay. Third one, shorts. Okay, now this one we're going to have to calculate now because we know it has been written down, so it's more likely than not that they, when they have an NRV, they might suffer some sort of loss. So it can be that the NRV is lower than the cost. But yeah, for safe practice, you could calculate that stuff for the trousers and NRV as well. But yeah, just kind of a faster way to do it. 25 for this one, for shorts. The supplies price is 25. Then we know up here, delivery in is 2 for the shorts. And the logos cost price is 2, $1 for the labor cost. So that should happen rather quickly, hopefully. Alright, so that's that. And here we do need to calculate this one. Right, so we can quickly look at our selling price. So selling price is 50 here. And then we're going to subtract. But then no, we know here it's been marked down to $30. Right, so it's actually the selling price is 30, right? So then 30 minus the 2 from the delivery out will give us $1.28. But then here, what we realize is this is not the lower one anymore. This is. So we're actually gonna erase a circle. Remember this is the lower one, so we value it at that. And then we do 28 times 6 here, so we're using the NRV because that's lower now. Oh, I think I missed something actually. Oh, yep, okay. So what I've missed actually is here. That's why I've not read the question. Trying to move fast. In a further bid to clear stocks, a pair of socks is also offered as a complimentary item. And this is like a marketing thing, and that actually also falls under NRV, which I've forgotten, which is my bad. Right, so when they make a sale for shorts and dresses, they're actually incentivizing this further, so it's a marketing cost because it's giving a free pair of socks with it. So socks was 6, right? So we're just gonna, sorry, this was my bad. I don't know what happened there. Minus the sock as well, because that is a marketing cost, because I've tried to further make people buy it. That's $1.22 now. That should be 22 times 68, which equals 1496, right? So like this we've done 3. I think we're going quite slow today. This one might take a bit longer, this SAC, and that makes sense because this SAC was quite annoying, especially when you have to explain every step. So hopefully that's okay for you guys. Yeah, so that's 1496 valuation for the shorts. Now the skirts. Okay, we know from up there that the quantity after inventory count was 82. The supplier's price was 35 plus the 2, which is for delivery in, and then there'll be 2 for school logo embroidery, and then 1 for labor costs. and that should give $1.40. And this one hasn't been marked down, so we already know that this is gonna be the lower one, mostly. It will be. I know what I'm saying, mostly. Don't worry about this one. It's because the 30 for the shots had been already marked down. So 40 times 82, which equals 3280. Yep, that's good. Five and six, we're almost done now. So dresses, and that's socks. I think that's 82 as well. Yep, both 82. 45 is the suppliers one, 3 for the delivery in per unit. 45 is the suppliers, cost price. Logo cost $3 for 3 dresses, $3 each for dresses, and the labor cost was 1. So should be able to do this rather quickly. And I've kind of color coded it for that reason, so I know exactly why I'm adding each of them. Hopefully it makes sense. And here I'm not going to circle because I should have stopped me last one because it's been marked down by $30, if you remember, each. So its initial selling price was 90 after the 100% markup, and then you subtract it, it'll be 60 now. So now that it's 60 minus the delivery out, which is the same as delivery in, 3, and then minus the sock, which will make this $1.51, which is subtract. It's actually lower, not surprising actually, expected, because it's been marked. Because they're trying to prepare stock for the winter, so they get rid of this summer stuff. So we take 51, not the 52. 51 times 82 is $4182. And then socks was, if you look up, it's 127. Then the suppliers per cost price was 5. Delivery in was 1. And that's actually all. And you already know this is going to be lower because it's not going to be anything, so you can pretty much keep it. And then it should be good. That took a little while, but I'm not expressing each stuff, you can kind of quickly work through this. But yeah, this is quite hard. So the total value of inventory is just the sum of all that. Sum of 762, 4182, 3280, 2684, 3478, and then 4961. You kind of take the sum of all that. That should hopefully get you 15882, which is yours. So yeah, that takes quite a bit of time, and it's 6 marks allocated to this. You actually do have to put this sort of working in, because you're not going to get 36 marks if you don't show this sort of working. But yeah, so that's that. I'm gonna move ahead quickly now. Prepare an income statement, extract. I don't like the green color for this, so we can actually prepare an income statement, extract up to and including up to and including adjusted gross profit on 30th April for April 2021, 6 months. Okay. And they're telling us that's the number of sales that has happened. Okay. Yeah. That shouldn't hopefully be too bad. Okay, so to calculate the sales value, we kind of just need to, that's a selling price of the shirt. No, 45 is a quantity. So the selling price of the shirt is 30, and they sold 45 of them. Then trousers, selling price 60. The quantity was 32. Then for the shorts, quantity 17. Selling price, because I knocked it down, was 30. Then quantity of skirt is 34. Selling price 70. Dress 35 is quantity. Selling price 60 because I marked it on from 90 down. And then 38 is the quantity of socks and selling price 10. And that should hopefully, so you kind of just use this table with the selling prices. Use table with known selling price to find sales. Right? That's what you're kind of trying to do here. And that should give you 8640 for sales. Right, so let's put in sales as 8640. 8,640. Okay, then what's underneath that is going to be less cost of goods sold. Underneath that is going to be, I'm actually not going to put this on a heading, so I'm going to change color here and make it cost of sales. Okay, for the cost of sales value, you kind of do the same thing, right? What you did for sales, but I'm probably going to have to use a different color. So for cost of sales, you have the quantity, and you need to use the cost price which you calculated, which is these prices here, and take those. But for the ones where NRV is low, you value it at the NRV one. So you take 22 instead of 30, you take 51 instead of 52. So cost of sales, 22 times 45, because the cost price of the shirt was 22 times 45, and 47 is the 32 is the quantity of the trousers, 47 was its cost price. And you kind of just do the same thing as you go along, but this one is 22 times 17. 17 is number of shorts, and you take the cost price is going to be the lower, the NRV is lower than the cost price, you value at the NRV, so it's going to be 22, not 30. Right, that's probably the trickiest part about this question. And you kind of just follow that along for the others, and hopefully you should, again 51 not 52 because NRV is lower than, so for the dress the NRV is lower than the cost, so NRV is 51 and cost is 52, so you still value at the 51. So you value whatever is lower between NRV and cost. It's kind of just drilling that into your thing. 51 times 35, and then finally 6 is the cost of the socks, and then quantity is 38. And when you should add this all up, you should get the magical number 6241. That's not magical, it's just the answer, so I'm just calling it magical. Yeah, so it's not too bad this part. Then customs duty, which if you guys forgot was all the way here, and because it's a period cost, it goes in the less cost of goods sold part of the income statement. So probably, if you guys didn't know that, should probably go revise that. But yeah, we called it period cost here. Flat $50,000 is charged. And then there's also a thread, which we also called a period cost. So, oops. Okay, that was not good. We also call this thread $100 worth of thread. This one, sorry. Yeah. Yeah, so both of them are going to be in the income statement under less cost of goods sold. This was 2,000. This is thread. You add that up. This was 100. This will be 8.41. So give you 299. You subtract that through because this will be under the heading of gross profit. Right, so our gross profit is whatever sales minus cost of goods sold, net sales minus cost of goods sold, 86 was minus 84, which will give you 299. And you kind of, because you want it to adjust your gross profit, you add inventory gain, and then you subtract inventory write-down, which then should give you adjusted gross profit. Right, so now let's calculate the inventory gain part. So if we go all the way up here, what we notice is inventory collateral 121 you found, so there's plus 1 here. So you gain 1, but then you lose 1 here, 75 grams. So it's kind of like a pattern here, if you guys see it. Plus 2 minus 2 plus 2 minus, sorry, plus 1 minus 1 plus 2 minus 2, plus 3 minus 3. Right, so essentially all you're doing is taking I could probably write it here. So inventory gain slash loss. I don't know, so I'm just gonna leave it empty for now. I'll fill that in this gap. So we know for shirt there's one more. That's 22 because all of them are made. Then trousers cost price was 47, but there was one less of it, so we kind of subtract from minus 47. And then shorts, the NRV was 22. We gained 2 of them, so we can evaluate at whatever's lower between cost and NRV, which is 22, not 30. Alright, but you multiply that by 2. And then you subtract that by 40 times 2, because we've lost 2 of the skirts. And the cost price of the skirt was 40. And then dress, it is valued at 51, not 52. So 51 times 3 minus then cost price of the socks, which is 6 times 3. And hopefully when you kind of calculate all that, that should give you 74 as your inventory gain value. So because it's a positive number, you know this is going to be inventory gain. So you kind of work it out like that. Right, so you just take what else in cost and NRV, and then you just add them through or like subtract them, because if you've lost it, then I'm going to subtract it off. And whatever you're left with, if you're left with a positive number, you know you have had a gain. If you're negative number, minus a loss. So, I kind of gave it away. I knew it was add inventory gain, so I wrote add inventory gain. But yeah, initially, you guys won't know if it's add inventory gain or less inventory loss. I kind of just realized what I just did. But yeah, just kind of go with that. Inventory write down. The formula for inventory write down is quantity multiplied by inventory write down equals quantity times cost minus NRV. Because inventory write down, we know that the NRV is suddenly dropped below cost. And that's why we're writing it down. For the inventory write down part, we know that the dresses, there are 82 of them, so we can kind of do 82 multiplied by the cost is 52 minus 51 is the NRV, plus, right, because there's two inventory write downs happening here. Same for that of the shorts, where there are 68 of them, and the cost is 30 and the NRV is 22. And when you kind of solve this down, that should give you 626. So that's the inventory write down part. So it's going to be a negative there, and you're actually going to have, surprise, surprise, and so when you do 99 minus 533, it's actually going to give you adjusted gross loss, and it's actually important to write that. The examiner's going to think you're sleepwalking if you don't, and just writing a negative number and saying that's a profit. So it's probably important that you do it. I'm going to probably just put it in another color. Let's pick purple because I don't know what else to pick. That looks horrendous, but yeah, okay. Don't judge my color choices, okay. Yeah, that's it. Adjusted gross loss to 34. Yeah, we should be good. Calculate the closing value of inventory at 30 April 2021. So inventory balance at end of April. At end of April of 15 April actually. $2021 equals this, which we calculated. And then they made all those sales, right? So we'll minus the cost of sales, which we calculated from earlier, 6241. And then they also had the socks, which was sacrificed for attracting some of the sale on the dresses and the shorts. So which is the socks used for marketing. So they made, so we sold 17 shorts and 35 dresses. So we can kind of just, so we made in total, what, 52 sales because of those. And with each of them we added an extra sock. So, say 110, we just kind of subtract and the closing value. Closing inventory balance at 30 April 2021 equals $9329. There you go. That isn't too bad. We're kind of picking up pace because yeah, the first part of these questions are much harder than the later part of these questions, which is good, I guess, to some extent. Alright, Uniform Central's income statement for April 2024. Calculate the gross profit margin. Okay, so we know GPM is gross profit over net sales times 100. And let's just go up and check what our gross profit was. $299. Our net sales was 8640. 299 8640. You're never actually going to be asked to calculate this GPM stuff. It's more going to be theory questions, testing your understanding about how gross profit margin works and everything. But yeah, it's probably good to understand this. You should be able to calculate it, because if you can't calculate it, you won't be able to analyze it. But yeah, so your gross profit margin for them was 3.46%. Evaluate the business's GPM for April 2021 using the benchmarks for 25% for the business in a comparable period last year. And market leader Uniform Bazaar had a GPM of 60%. These are two benchmarks. This was previous period ratios. And then this one was market competitor. So it's like your industry average, but this is the best one there. It's because it's easier competitive. It's the best gross profit margin. So what we can say for this question is businesses GPM for April 2021 is extremely unfavorable. As it has significantly decreased from last period GPM. So business generates approximately our current one is 3.46%, so if we kind of round 22 cents lesser gross profit per $1 of net sales in April 2020. So yeah, significant percentage of net sales. Percentage of net sales that is returned as has dropped, which is not good, obviously. And then we can also say, furthermore, April GPM way lower than market leader GPM. Something like that. So we're kind of getting 2 marks for this evaluation. So I'm just gonna, you could probably write better than this, but yeah, just saying something like this for 2 marks should hopefully be fine. Then there's 2 marks to actually outline a couple reasons why this is the case. So you can write one of the impacts. High amount of customs duty as it was a period cost led to lowering gross profit of business. That's one reason. Another reason could be, from the case study, we can say this may have been caused by the effects of the COVID-19 pandemic. I'm not going to write this, I'm probably just going to read you what, not read, sorry, probably just think about an answer and just talk you through it. Effects of the COVID-19 pandemic. I'm not going to write this part, I'm going to say it. So this could probably lead to the business having to write down their shorts and dresses due to likely lesser summer purchases, as during pandemic people didn't go to the beach or something and didn't go outside that much and were stuck in their homes, so they did not gain that much sales and as they expected. So they probably would have bought much more energy than they needed, and they didn't actually make those sales. So it's the GPM might have gone lower for that answer because they didn't make as many sales, leading to gross profit being lower, leading to the gross profit margin being much worse than the previous period or their competitor GPM, who might have found an online route of making these sales, while you might only have an in-store sort of enterprises. Just something like that. Just trying to use your common sense. The two ways, yeah, you have to really talk about this one. This one is actually a lot to talk about here. It can be anything. How can COVID-19 ever impact some businesses' gross profit margin? This is like a real life scenario. So you can think about a lot of businesses that have struggled in COVID-19. So you can just kind of list one of those reasons. And that's why their GPM must have been lowered. We kind of link it to this case specifically. Anyways, let's move ahead because we're still in question 1 with 1 hour gone. Yeah, I've just been trying to explain it to you guys. It's taking quite a bit of time highlighting everything, but yeah, in the exam and everything, you guys are going to have to speed through this question. Hopefully you should be able to get it done, just because this is first time stuff. With me explaining, I'm taking a bit longer. So this question, explain the difference between gross profit margin and net profit margin. Okay, this one isn't too bad. Percentage of net sales that is retained as gross profit. And another thing is indicates whether markup adequately applied. This is crucial. And then for net profit margin, percentage net sales that is retained as net profit. Sorry guys, pen lagging. I'm trying to write fast because we're going quite slow. But it's good. Hopefully you guys understand this. That's more important. And net profit ability of business to control expenses. That's another key thing to state, specifically for net profit margin. What it kind of measures compared to gross profit, it checks whether the markup has been adequately applied. Yeah, okay, so that's question 1 done. Hopefully now we should get it. Go through this paper a bit quicker, but yeah, this is still going to take a bit of time, guys. But hopefully we can get through this now. Alright, Motherwell's Minerals is the leading, so that's the business's name. Distributor of herbs and minerals across the east coast of Australia reports quarterly. So we probably want to care about that, obviously, and sells all of its products on 100% markup. We obviously care about that. Okay. And the company's closing entries for the period ending 31st March 2022. Yep, and they've given us everything, and we just gotta close this, right? If I'm guessing, and they've given us this stuff as well. This is the drawing stuff. First off, I'm already thinking, where's cost of sales? Alright, and then we already know. Immediately I'm thinking, where's cost of sales? Obviously. So when I look at this, I'm going, cost of sales missing, right? So how do I calculate cost of sales? Cost of sales is sales, like net sales divided by 2. Right, so because it's divided by 2 because there's a 100% markup, right? So we know this is going to be 45,000. The tricky part here, they've said net sales, but when you're writing this in your closing entry, you're actually going to have to realize net sales equals sales minus sales returns. And when you sub in, like, rearrange, you actually understand that sales equals 100,000. We actually care more about this value and the sales return value than the net sales value. And yeah, from there it should be good to go. So yeah. So the purpose, it's actually really important. It's a four-step process. I'm just going to talk you guys through this. You close revenues, you close expenses, you transfer profit or loss to the capital account, and then you transfer drawings to capital. So 4 steps, right? These 4 steps through, and you should be fine. And the purpose, it's really understand, like, if you think about it intuitively, it's good, because the purpose of this is to reset revenues and expense accounts to 0. So you're just trying to nullify all the things you did, because you're trying to reset it to 0, as they don't transfer to the next period, right? Because only assets and liabilities transfer to the next period. That's why that goes in the balance sheet. But like your revenues and everything, it doesn't matter what it's in the next, like what you had in the last period doesn't make a difference in this period. They just don't transfer over, so you can make them back to 0, and that's the whole point of this. Right, so let's go. So first let's start with closing revenue. So for this, we're trying to nullify, we're trying to reset it back to 0. So sales initially, these are all revenue, so these should be in fact be a credit, right? But now we're trying to reset it, so we're trying to put it as a debit to nullify and set it back to 0. So sales we've calculated was 100,000. So now we're going to write it as a debit. Inventory gain, also same as that, was a credit, but we're going to reset it back to 0. So we're going to put it as a debit. Discount revenue, same thing. We have discount revenue as 2,000. Sales returns is actually a negative revenue, which should be a debit. We're trying to reset this, so we know sales returns is 10,000. Yeah, so we're trying to reset this, and now it's going to become a credit. So it's all just resetting everything. You're trying to make everything back to 0. And another quick way, if you don't want to overthink everything, you can just think P/L summary. The profit and loss summary part, this one, will be, so if you're closing revenues, you put the P/L summary on the same place where revenues usually go. Like when revenues increase, put it as a credit, right? So that's, you put the P/L summary, and then you can just put everything else on the reverse side. So that's 97,000. Yep. As you can just simply, you're trying to balance it out. So 100,000 plus 5,000 plus 2,000 plus 10,000 plus 97,000. So yeah, close that. Quick way to remember closing revenues, because it will be a credit when you're closing revenues, and when you're closing expenses, you can just put P/L summary as a debit and all the expenses as a credit, and that's going to nullify expenses because they're usually as a debit. But when you put them as a credit, they put them back to 0. Just about understanding, intuitive understanding. Don't try to memorize this because it can go really wrong. Because these are quite simple marks. So we know we want to make into so now we're closing expenses, right? So advertising expense, like all other expenses, will be a debit usually, but trying to reset it. So just put it as a credit instead of debit. That's going to push it back to 0. Right, so this is not too hard, this part. I'm just going to quickly do this. Advertising, wages, interest. And importantly, we calculate the cost of sales as well. That's 58,000. Debit connect. You just add up everything. Those who think my writing is horrific, I agree that it was not an 8, that was actually a 5. There we go. Okay, so now before we go ahead, we need to figure out if there's a profit or a loss. Right, so we can kind of, so when you had, essentially you had 97,000 of revenues, and you had 58,000 expenses. That gives you 39,000 of profit, right? Now when you're transferring this to capital, think about this. Don't memorize anything, just understand this part. Capital is usually a credit when it's increasing, right? This is the owner stakes. If you made a profit, the owner stakes are going to increase. So if you want to increase capital, you would credit capital by 39,000 because you made a profit, so more like the owner stakes will increase. Like owner made something out of this thing because whatever his business did in this period made him a profit, so his claims in the business also increased. Like 39,000 is what he made. I don't know how to explain this better, but like, think about the fact that profit means the business's capital is going to increase. Or like the owner's like, you know, that yeah, the capital is going to increase. So that's, how do you make it increase? It's through credit, right? Just think about it that way. And then you just try to nullify p/or something because you don't really care about it. Because its job was just to help calculate profit. And lastly, again, think about this intuitively. Drawings. We have $10,000 cash, $2,000 inventory, right? Okay, when you took drawings, the owner is actually taking out some of his claims in the business, on the business, like if the owner owns the business claim in the business has been lowered by 12,000. That's a better way to say this, because he took out $10,000 from the business and used it for his own good, right? So he's taking it out. That means capital, which if it was to be increased, it would have been credited, but he is decreasing, so capital is going to be debited by 12,000. It's just about logically understanding this. If it takes some time, it takes some time. This is not the hardest thing in the world, but once you get that, like, initially it may seem a little difficult, but once you get the hang around this, this is not hard. So yeah, this is the 4 steps. First step, we closed revenues and we closed expenses. Then we transferred profit to capital. And finally, last step, we transferred drawings to capital. Just a 4-step process. It's nothing, not the worst thing in the world. Okay. Okay, so explain the effect. Okay, effect is back at it again. Okay, this is not too bad, it's just been annoying to do. Explain the effect that each of the following transactions will have on the accounting reports of a business. So we need to say the impact on all 3, right? Because this SAC is going to cover cash flow, income statement, and your balance sheet stuff. So we're kind of wondering on both. So write down an inventory from 12,000 cost to 10,000 NRV. Okay, so we know there's an inventory write down. Cost minus NRE, which is 12,000 here, 10,000 here, which is just 2,000. There's an inventory write down expense of 2,000 due to the inventory being superseded, right? So the impact on the balance sheet, so your assets will be lowered by $2,000 as inventory reduces by $2,000. Okay, I'm just gonna write inventory reduced by $2,000, right? And liabilities have no effect. Furthermore, OE reduces by $2,000 as inventory write down. Expense increases by $2,000, something like that. Then the impact on the income statement. So the adjusted gross profit and net profit, because the inventory write down part goes in between gross profit and adjusted gross profit. So the lower adjusted gross profit and net profit by $2,000 has increased inventory write down. Expense by $2,000, something like that's good. Cash flow statement, obviously no effect. Like there is no cash involved in this. Okay. Loan repayment of $5,500, including $500 interest to Commonwealth Bank. Okay. This shouldn't be too bad. So what we can do is balance sheet, assets decrease by $5,500 as bank decreases by $5,500. Liabilities would decrease by $5,000. So all of that loan has been paid off. As loan paid off. And OE decreases by $500 as interest expense increases by $500. And cash flow statement, the operating outflow, because you can't actually just say, oh, the impact on like bank. You actually have to break it down, because this is the only way they're testing cash flow in the SAC. So operating outflow, interest paid. So operating outflow is just like the general daily activities of business. So interest paid by $500, and then there's a financing outflow because loan repayment. Because financing activities look at how the business's structure changes, and loan repayment will change it and change the business's structure. So loan repayment $5,000. Yeah, and that should be good. And income statement, we can pretty quickly say this. Net profit decreases by $500. As we said this earlier, as interest expense increases by $500. Something about it. By the way, if you guys don't understand, balance sheet is pretty much the impact on the accounting equation. Cash flow statement is showing impact on cash, and income statement showing impact on profit. So something like that should do. Cash purchase of equipment, $2,000 plus GST from Bunnings Warehouse. Okay, okie dokie. Balance sheet. Assets would decrease by $200 as bank decreases by $2,200, as you have to pay not only $2,000 plus some GST on top, but equipment increases by $2,000. Liabilities decrease by $200 as GST claim decreases by $200 due to purchase. And OE has no effect. It's important to say no effect. Summarizing accounting equation, if you leave liabilities blank, they'll think you don't understand. Like before, a normal question where there's no impact on liabilities. If you don't say there's no effect on liabilities, they might just assume you just didn't know it, so you left it blank. So it's important to say that. Trust me, because accounting, they can be quite annoying in marking this, because many people get quite high scores in mechanics. You want to make sure you're the best. Just show your understanding anyway, don't leave any gaps, which they can exploit and try to take marks off for no reason. Profit has no effect. So income statement has no impact. No effect, so income statement the same. Income statement IS is the same. Finally, cash flow statement, last part. Operating outflow. GST paid. $200. And investing is operating day to day. Investing outflow is a cash purchase and sale of non-current assets. Equipment is non-current asset which we've been purchasing. So this is part of investing outflow because it's purchase of a non-current asset. Purchases. There we go. Because it's non-current asset. Yeah, okay, that's not too bad. Question 2 took us only 20 minutes to do, which makes sense. Sorry, question 3 didn't take us that long, so yeah, currently 9 blocks didn't take us that long, maybe 10 minutes, and question 2 also just took us that 10 minutes. So yeah, we're kind of speeding through this now. Last question, only 4 marks. We can probably get to this soon, and you guys can go ahead. So we should be done with this soon now. Yachtman's Yachts is a yacht and boat seller which operates along the coastline of St. Kilda. Its owner Yachtman has some decisions to make regarding cash flow heading into winter and a down period for his business, and he seeks your advice. Okay. Provide 2 inventory management strategies that Yachtman could employ in order to appropriately manage his inventory until business picks up again in the warmer months. So, for inventory management strategies, I would suggest you guys use it right in order to appropriately manage his inventory. Is that he identifies slow moving lines energy. And then discontinue with these. And discount whatever left of this stock. To get rid of the slow moving lines and only prioritizing like the faster moving lines. Right. That's one thing you could do. Quite a common one that is actually you would actually just prioritize your faster moving lines and reduce any of the system and to the business. But you could say here, I'm going to give you probably two options: rotate inventory placements within the store, or you can rearrange inventory to include more in-season items. I like the second one. From these two, I like the rearrange inventory to include more in-season items. More. Yeah, so you probably go with any of these. Should probably do. Okay. Provide one. So we only need to provide one mechanism the item could use to improve the following performance indicators to assist with cash flow to the winter. So okay, so for accounts receivable turnover, he can offer discounts, or if he is already offering more, like if he's already offering discounts, more incentivizing discounts to encourage accounts receivable to settle their debts. Their debts quicker. To access discount advantages. So if they're paying back faster, the accounts receivable is going to end up being faster and improve. That should be good. Accounts payable turnover. There's probably quite a few things you could say here. You could say, probably just going to give you three. Yes, and pick all these like employee and actual officer. Accounts payable. Accounts payable officer. So you can manage it, so you make sure everything's on time. So you don't like forget to pay something. And so your accounts payable turnover goes really slow, so you don't do that. When you have the cash, you want to make those payments so that your supplier keeps allowing you to get like credit services, which is really valuable for most businesses. Another thing, capital contribution. I was going to say cap contribution. If business struggling for cash, to pay up to a time. This is not always possible because there isn't always a unlimited amount of money, but this is one thing if you guys want to see it could. I'm not saying, it's probably I would say decrease selling prices to increase sales volume. Right, so here, and then when you increase sales volume, likely greater cash and profit made, allowing accounts payable to pretty quick. So then the actor would get faster, which is good. Yeah, so probably these are some of it, and I think that's it, right? Yeah, I think that's it. So yeah, guys, that's the end of the SAC. 1 hour 30. Yeah, I think question 1 is probably just the most challenging. That's the one we spent most of our time on. But yeah, I think it's really important that this question you understand, because I think the rest of the SAC wasn't too hard. It's just this question with the understanding of period, product, NRV. Yeah, it's something that common people struggle a lot in the exam as well. So I think this is good if you guys can get the hang of this. I know it took time, but breaking down like this in the long run, when you keep practicing, the time won't be an issue. So yeah, that's the end of this one, guys. I'll probably see you in the next one now. Right, see ya.